In India's top metropolitan markets, a standard residential property purchase now takes decades just to double in value. These Tier 1 cities have reached a saturated end-user phase. With entry prices at historic highs, the math for massive capital appreciation no longer works for the average investor. Look at the current state of major metropolitan infrastructure. The extreme congestion shown here highlights why the quality of life in these cities is declining, even as costs continue to climb. This pressure is redirecting capital toward Tier 2 cities like Dehradun. These markets are absorbing a post-pandemic shift of professionals seeking remote work flexibility and better air quality. This contrast is the primary draw. These Tier 2 hubs offer the idyllic lifestyle appeal that major metros have traded away for density. But moving capital to a smaller city is not a guaranteed win. Without a specific strategy, it is remarkably easy to lock your money into a dead asset that fails to grow or liquidate. Most buyers entering a Tier 2 market struggle with asset confusion. It is the paralyzing choice between raw land, which offers the highest potential ROI, and an apartment, which provides immediate lifestyle comfort. Then there is the location trap. You have to decide between the high prices of an established city center or the high-risk, high-reward corridors on the outskirts. We map these choices onto a quadrant chart. The horizontal axis is your goal, comfort to yield. The vertical axis is effort, passive to active. A retiree seeking a second home is in a completely different zone than a young investor chasing a fast exit. To find your specific path, you have to weigh 3 specific trade-offs regarding your advisors, your location, and your physical asset class. The first trade-off is choosing who will execute your strategy. Most people default to a standard transactional broker. A broker's model is built on speed. They have a specific inventory of houses and plots, and their goal is to close you on whatever is currently on their books. The trade-off here is objectivity. A broker pushes you toward the single property that maximizes their commission, regardless of whether it fits your broader portfolio. A strategic consultant takes the opposite approach. They analyze your total capital first, looking at how to allocate it across different risks before looking at a single property. A broker might put a 1 crore budget into a single property. A consultant recommends a 1 crore split. By dividing capital, you keep a liquid backup, secure a rental property for cash flow, and put the remainder into a high-growth land parcel. The trade-off for this consultant-led approach is complexity. It requires more time for due diligence and the management of several smaller assets instead of buying one large, simple property. Ultimately, strategic capital allocation is a much more effective tool for building wealth than chasing a single hot property. The second trade-off is deciding exactly where to deploy that capital within the city. You can invest in an established city center. These areas have functioning schools, established hospitals, and paved roads today. This historic clock tower area represents the peak price developed center. It is convenient, but it is also finished. The trade-off in the city center is growth. Because the infrastructure is already there, it's already built into the price.
You are buying for stability, not massive appreciation. The alternative is to buy based strictly on the government master plan. This means targeting emerging highway corridors, where development is scheduled for the future. This decision matrix reveals the split. The city center offers immediate utility at a high price. The master plan route offers a low entry price and high growth potential, but at the cost of current convenience. You are either paying for past development or enduring current inconveniences to invest in future yield. The final trade-off is the physical asset class itself, selecting the vehicle that matches your risk appetite. In Tier 2 markets, raw land or individual plots are finite assets. Since they can't be manufactured, they typically offer the highest financial returns over time. The trade-off for land is the management effort. You have to secure the plot, handle future construction, and deal with a lack of built-in security or communal maintenance. A luxury apartment or society flat offers a turnkey experience. You are buying into a city within a city, with gated security and shared amenities. The trade-off here is the overhead. You pay a premium for those amenities, and the sheer supply of apartments in a single building generally limits how much they can appreciate compared to the ground they sit on. This scorecard ranks the two classes across yield, security, and effort. Land takes the yield category, while apartments sweep security and effort.
The best asset is determined by what you value more: immediate peace of mind or maximum long-term profit. Buying based on hype leads to stagnant portfolios. To win, you have to self-identify which path actually matches your needs. This decision flowchart maps 3 distinct starting points based on your current situation. First is the lifestyle escapee. If you are relocating from a major metro for health and security, prioritize luxury apartments in established zones. You accept lower appreciation for the immediate lifestyle upgrade. Second is the pure yield investor. If your goal is purely financial, ignore high rises. Target raw land on master plan corridors and prepare to hold for 5 to 10 years. Third is the beginner. If you are capital constrained, you must use the diversification split. Prioritize low-risk rental assets first to build cash flow before chasing high-risk appreciation. Success in emerging markets requires aligning your location and your asset class with your specific life stage. For all 3 paths, the final barrier is the same: separating legitimate opportunity from marketing hype. Deep due diligence is non-negotiable. Always verify RERA numbers on government sites and use government bank checks to uncover hidden liabilities. Treat this structural verification as the foundation for the entire deal. If you are following the master plan, you must also have immense patience. Infrastructure projects can take years to move from a blueprint to a finished road. This is the reality of urban development. This image of construction cranes and unfinished structures represents the timeline investors must endure to see their returns. The primary opportunity for capital growth has moved to Tier 2 cities, but it only rewards those who replace hype with strategy, patience, and aggressive due diligence.